Welcome to Accredited Real Estate School's fourth quarter of 2022 real estate update. I'm Bryan Church, and I'm the founder of Accredited Real Estate Schools back in 1995, and we'll continue on today. So let's get started. The increase in energy costs has caused an increase in distribution costs and resulting cost push inflation. Specifically, gasoline and fertilizer are in short supply, and since there's no rationing in place, prices tend to increase with supply and demand. As supply decreases and demand stays the same, prices will increase. So, what's happening is that the Federal Reserve, as usual, has misdiagnosed the problem. They think that the inflation that's happening is being caused by demand pull, which is consumers seeing prices going up and wanting to move purchases into the present that they're going to be doing in the future, and that causes a demand pull. The cost push inflation is caused by costs. In this case, it's going to be energy costs, and those are, of course, causing the prices to go up. The Fed hasn't figured that out, and of course, they're increasing interest rates, thinking that's going to happen, and they can't figure out why it's not reducing the inflation rate. But it's because they've misdiagnosed it. This is pretty typical, and all the hedge funds are always trying to front run them, try to figure out, okay, what kind of dumb moves are they going to be making so they can try to make sure at least stay out of their way, if anything. Now, the Fed thinks that there's an 8.5% inflation rate that's coming from demand pull inflation and has misdiagnosed the cause of increasing prices. In response, Fed's increased interest rates in an attempt to reduce this rate of inflation. They are not aware of their misdiagnosis. Inflation will continue, just like I had mentioned. By the time the Fed realizes its mistake and begins to reduce interest rates, the U.S. economy will have entered a severe recession, which is where we already are right now, even though no one is saying that. Anytime you have 2 quarters in a row where there's negative growth, then you have a recession. And what's happened is the growth's really, really reduced down. As the recession continues, people will buy less discretionary items, those are luxury items, and even reduce disposable, which are necessity items, like food, which is a major thing. And this will result in a reduction in the inflation rate. So they think that they are just being caused by demand pull. It's cost push. People are now getting crunched, and not only is it discretionary, entertainment, things like that, but also food. They can't buy as much food as they did in the past because of food inflation. So not only do they have, increase of gasoline prices at the pumps, but they're also having food going up. Bottom line is that interest rates are expected to increase another 1.75% over the next 2 Fed meetings, or so, and thereby stalling out real estate markets when buyers must pay a significantly higher interest rate for owner-occupied home loans. They will only qualify for a much lower priced home with the buyer's same income. This will occur with a decline in productivity causing stagflation and hopefully not hyper stagflation in the future. So, Jay Powell is hell-bent on destroying the economy by increasing interest rates very, very fast rate. And of course, 30-year fixed rate loans are going to be, they're already 6-7%. They're going to go higher than that, which of course is stalling out the real estate markets. You see that with the new home builders. They went to a screeching halt in California. So that's going to continue on. And of course, owner-occupied buyers can buy less and less because they can only qualify for lower loans and therefore lower price homes. So we're seeing that going the other direction very quickly. The question is, when is the Fed going to make a turn? They're calling that a pivot. And we thought they were going to do it end of this year, early 2023, but it looks like it might go all the way through to the end of next year. We could end up with stagflation, which is no growth, and inflation continuing according to the costs, energy costs. And it could get to a really high rate. So that's stagflation. So that's where we're at right now. And it looks like the Fed's doing everything possible to try to stop the inflation, but they're doing the wrong things, and they're going to end up with a train wreck at the end. Unfortunately, we're going to be in it. We're trying to help you stay out of it if possible. So anyway, we have real estate, and real estate loans are considered inflation hedges. Real estate tends to track inflation in the long term. However, prices will initially decrease with increased interest rates, but will usually trend higher over time. Real estate loans are also an inflation hedge because borrowers borrowing the money at a lesser rate than the inflation rate. And so, for example, when a real estate interest rates are at, say, 5%, 30-year fixed rate type thing, and the rate of inflation is 8%, then 5% minus 8% is minus 3% real interest rate. And this means that, say, $100,000 loan times 3% is $3,000 per year is going into the borrower's pocket in terms of value. So it's an inflation hedge. So that's why people get loans when they think that inflation is coming. And when they think deflation is going to be here, like we've had the last decade or so, then they will not do loans unless they're just trying to for just merely leverage. So from an inflation standpoint, real estate loans are not only can be used for leverage, but they can also be used as inflation hedge. And so, but remember, as the inflation rate starts reducing, so does the real interest rate will then go back to zero or higher, and then you don't have that advantage anymore. So as right now we're seeing the interest rates are going up, but we're also seeing the inflation rate going back down a little bit. So we'll see where that's going. So when inflation changes to disinflation, that's a slower rate of inflation, excuse me, and then to deflation, which is prices going downward, this advantage will disappear for the real estate investor. For example, interest rates remain at 5% minus 4% rate of inflation, 1% borrower's cost for the loan. Of course, all cash and no loans is the best scenario during deflationary environment. Again, unless you're going after leverage. Real estate prices are expected to decline through 2023. By the end of 2023, the Fed will have discovered their mistake and reverse course with a decrease in interest rates in an attempt to save the U.S. economy. The Bank of England had to reverse course last week, as a matter of fact, when their pension funds began to implode and they were forced to institute quantitative easing, which what that entails is buying treasuries and mortgage-backed securities. It's usually a long-term fix also for interest rates, not just a short-term one when they start doing that, to save their entire financial system, which of course the Federal Reserve, the U.S. Federal Reserve, which is the U.S. central bank, is watching that closely, I'm sure, because the U.S. has a lot of pension funds that are in very precarious funding positions. And then we have, this could have been a Lehman moment when the entire world financial system starts to implode. Pensions in the U.S. are in a precarious position in which they have promised more pension payments than their investments can produce. One of the reasons for the COVID bailout was to bail out the state pension systems. As a matter of fact, the island of Maui had increased property taxes for certain property types to cover their pension shortfalls. Of course, that's all the owners from off the island, right? Were end up paying for that. This increase was discontinued when the federal COVID money arrived from Washington and went into Honolulu, then over to Maui. So they were actually increased their property taxes, and then they brought them back down when the money showed up. That was to cover their pensions. So I got to figure that's probably what's going to happen down the road with the U.S. as well. According to one of the large 1031 exchange intermediaries, they're seeing a large number of apartment owners with permanent rentals moving their equity into short-term vacation rentals. This appears to be in response to the Center for Disease Control, CDC's eviction moratoriums instituted during the COVID pandemic. Of course, there are dangers with vacation rentals too. For example, Hawaii closed down the islands to tourism for several months during the pandemic, and property owners could not get onto any of the islands during this period. Another risk for vacation rental owners is hurricanes, as seen by what happened in Hurricane Ian in Florida, which just happened just recently. So anyway, they're going in and moving out of apartment buildings into vacation rentals, hoping they don't get into these eviction moratorium issues. It's not a bed of roses, though, with vacation rentals, because with them, you still have issues like, for example, they closed down Maui. The ones in Florida have done pretty well, except the ones that got hit by Hurricane Ian on Fort Myers Beach and Sanibel Island there, and they got hit the most. And Pine Island did too, but they don't have as many vacation rentals over there. Cape Coral was hit, but they didn't get hit nearly as bad because a lot of those are sitting up quite a bit above the canals with that. So that's an issue with vacation rentals, and so we're seeing a lot of people moving into those, and hopefully that'll be a good situation for them. So, so we can get this figured out. People received more income during the pandemic than they received before it arrived. Now they want the same income they received during the pandemic. However, they do not produce enough value to meet this amount. In other words, people receive more money than the value they produce. Labor unions dig in their heels. Business owners will be forced to automate as much as possible, stay in business. So that's what we're seeing also is that people are wanting higher wages, but the problem is that they're not producing enough to cover that from a business standpoint. So automation looks like it'll be the thing of the future, and so that's going to be a risk. And then we have, we generally thought that the Fed would not continue increasing interest rates because it will cause a recession and crash the stock market. Now it likes Jay Powell's hell-bent on increasing interest rates at least another 1.75 through the rest of 2022, maybe into 2023. Investors have been fleeing the stock market, buying physical assets. Many are holding a significant amount of cash so they can be nimble when looking for good deals in the future. The same may be said for real estate deals in the future as interest rates increase and real estate prices decline. So there should be some really good deals down the road for all cash buyers, not only in the stock market, but in the real estate market too. Some people try to get good deals where the hurricanes, things like that, and you can get some deals on those, but that usually takes a while for that to shake out because of the insurance claims and everything. What they're also looking at is just flat out in reduction in real estate prices because of the interest rates going up. And then, of course, if you're dealing with cash, you're in a good position on that. Anyway, that's our update for the fourth quarter of 2022. This is Bryan Church. I'm, in fact, founder of Accredited Real Estate Schools. And we're going to thank you very much. We'll be back again in January for the first quarter of 2023 and see if this train wreck is hit or through or what's going on, but see where we can make some profits down the road. Thanks very much.